Most of the investors are extremely focused on the entry part but ignore the exit strategies. In my experience, exits are largely an afterthought. When the markets are rising, greed dominates. When the market falls, then fear dominates. And either they exit in panic and incur some losses, or they didn't want to act at all. Today, most of the exits are largely reaction driven and they are not process driven. Investors just don't react to market, they overreact to their own emotions. Rebalancing requires you to go against your instinct. Rebalancing works the best when it is boring, consistent, and it is rule driven. There is a saying that the biggest risk to your portfolio is not the market, but it's you through your emotional decision making. In fact, most of the investors are obsessed with what to buy, but long-term success depends on when and how you align what you already own. The ideal exit approach should not be seen as leaving the market, but as rebalancing within the market.
Market discussions are often limited to what to buy and when to invest. But an equally important question is, what really happens after that? How often should investors review what they already own? What happens when the original portfolio mix starts to drift? How to stay aligned with your original goals when market volatility and emotions start to interact? Joining us today is Mr. Shiben Bhowmick, founder at SB Wealth Management. With over 18 years of experience in wealth management and a long-standing focus on investor guidance, he brings a practical lens to questions around allocation shifts, portfolio reviews, and behavioral decision-making in investment journeys. In this episode of Nivesh Pe Charcha, we explore why exit planning matters and how rebalancing can bring more clarity to investing decisions. Mr. Bhowmick explains why exit decisions are often overlooked, how emotions can influence behavioral decision-making, and finally, how can investors review their portfolios based on changing goals, incomes, and life circumstances. Let's dive in. Hello, Mr. Bhowmick. Welcome to Nivesh Pe Charcha.
Good morning, Mukul, and thanks to your team for inviting me to talk on this interesting topic.
Our pleasure, sir. Sir, let's just jump right into the topic. When it comes to markets, there is a lot of information that's available when it comes to buying products, किस में हमें invest करना चाहिए, कौन सी चीज़ों में. But there's very little information on how to exit an investment. So in your experience of dealing with investors, is it something that investors even think about? And what's been your experience so far about exiting an investment?
Yeah, Mukul, that's a very relevant observations. And what we find day to day is that most of the investors are extremely focused on the entry part, but almost completely ignore the exit strategies. In my experience, exits are largely an afterthought. Investors spend a lot of time asking that which fund to buy, what are the sectors that are performing, and what are the industry leaders, which company will become the industry leaders, right? But they rarely ask the questions like, when should I reduce my exposure to a particular asset? What happens if these allocations become excessive? For example, when we construct a portfolio, we have access, we have asset allocations for different caps, right? Small cap, large cap, mid caps, and also to debt and other commodities also. So, as per your risk profile, this is constructed. The reason for this, I think, is largely psychological. When the markets are rising, greed dominates and investors don't want to sell their winning stocks, right? Who wants to sell their winning stock? The stocks which are performing well, they try to remain invested in those stocks, right? And the reverse happens when the market falls, then fear dominates, and either they exit in panic and incur some losses, or they don't want to act at all. And that's when you can see in this beautiful chart which shows the market cycle and its relation with the cycle of emotion. As we all know that market goes through a cycle, that our emotion also goes through a particular cycle. And it starts with optimism when there is news about a particular asset or a stock which roam about in various news channels, and the excitement begins to build up and it reaches the level of euphoria. And at this level, you will see that the most of the interest are there for the, because you will be getting news from all the fin influencers, all news channels and the medias. But this is the peak of a particular assets. Though people enter at this point, this is a point of maximum risk of making some gains, right? Then as usual, the curve flows a downward path. There is then fears comes in, then panic sets in, and at the bottom of it, there is depression. And again, the prices reverses, and again it reaches the level of optimism. So it's a cycle. As the market goes, our emotion also goes through a cycle uh, in this market, right? What happens is that many investors build emotional attachment to their investments. For example, they have some fund which has done well for me, so why should I get out of it? Or if a stock doubles in time, then I should hold to it, right? This creates a level of inertia in the part of the customer. At SB Wealth, we approach this very differently, because here exit is not an event, it's a continuous process of portfolio alignment. We don't wait for the extremes, that whether it's a correction or whether it's a peak, whether there is overvaluation. We build an exit thinking into the portfolio construction itself through proper asset allocations, through periodic rebalancing, and through valuation awareness. In fact, most of the investors are obsessed with what to buy, but long term success normally and actually depends on when and how you align what you already own.
Fascinating, sir. So it's it's generally an afterthought when it comes to investors based on what you have experienced so far, but it should not be. So, sir, you mentioned that it's an afterthought, but what exactly should investors be doing? You mentioned what they are doing, but what is it that they should be doing when it comes to exiting an investment?
Yeah, as you can find that today, most of the exits are largely reaction driven and they are not process driven. Typically, when there is a bull rally, we have an attitude like, let me book the profits, or during a correction, let me reduce the risk. So, decisions are driven by market movements and not by the need of your portfolio. The problem leads to a classic behavioral mistakes, like you are selling your winning stocks very too early, right? And then you are holding on to the losing stocks because that's dear to you, because since you have bought to, you are getting attached to those stocks. Then exiting in a panic when there is a correction in the market, and you exit in panic because you
Yep.
feel that your portfolio CAGR will reduce considerably, so you sell in panic. Those are good quality stocks, but you sell them. Then entering late, that is in the last diagram, we saw that the euphoria phase, you are entering late when it's already at the peak of its valuations due to FOMO, that is fear of missing out. You don't want to miss any action in the market, right?
Yeah.
Then investors just don't react to market, they overreact to their own emotions. And this is a diagram which shows the relationship between your fear and panic, right? And normally, when a price of a stock reaches a resistance level, you enter that stock out of greed, that you think that it will go up. But again, that is at the point A you are entering. And but when the prices comes down to the point B, you exit out of panic because you think that you have made a wrong decisions, right? So that is the support level. And from the support level, the price of the stock or the asset can reverse. But some of the people will still hold on to the stock, and they will see that my principal, I should get back my principal, and they will hold it much longer to the point of C, when they will recover recover the capital amount, and they will exit the market, and then the stock will give a breakout, right? So this the ideal exit approach should not be seen as leaving the market, but as rebalancing within the market. You should not you should didn't have to leave the market. You can rebalancing it as per the requirement of your portfolio. Especially this is true for a market of India, which is a capital rotation market. Capital rotation works in various ways. Like there can be leadership shift in a particular sector or a particular industry, because there could be movement of capital, and we know that there is movement of capital from large cap to mid cap to small caps, and again this cycle repeats itself. Then there is movement of capital between different asset classes like equity, debt, then precious metals, then to bonds, and then again back to equity. So this always happens. Market is a dynamic place. It is not a stagnant place, right? The idea is not to exit the market, but to stay invested, and stay invested in the right part of the market. Our philosophy is that we try to achieve this through a disciplined rebalancing, then valuation based adjustment, and goal aligned allocation. And very importantly, we manage the portfolios with logic and investors with empathy, because the hardest part is not the strategy. it's its execution under emotional pressure. The exit, as you have answered with the exit should not be a reaction to the market. It should be a response to your portfolio imbalance. That should be always be, we have to keep it in mind.
दैट्स अ वेरी इंटरेस्टिंग पर्सपेक्टिव। तो आप ये कह रहे हैं कि एग्ज़िट का मतलब ये नहीं है कि आप मार्केट से निकल जाएँ। एग्ज़िट का मतलब जनरली ये है कि या तो आप अपने पोर्टफोलियो को रीबैलेंस करें, एसेट एलोकेशन को अच्छे से समझें, मे बी रिव्यू करें। सो व्हेन यू आर टॉकिंग अबाउट रीबैलेंसिंग, आई एम श्योर अ लॉट ऑफ अस वुड बी इंटरेस्टेड इन नोइंग कि ये रीबैलेंसिंग नेसेसरी कब होती है? इट्स नॉट लाइक वी कैन डू इट एवरी डे, राइट? ऐसा भी नहीं है कि हम सालों तक नहीं देखें। तो व्हाट इज़ इट व्हेन रीबैलेंसिंग एक्चुअली बिकम्स नेसेसरी?
Yes, rebalancing normally becomes necessary whenever your portfolio drifts from its intended allocation. You have constructed the portfolio with some intentions, right? It can be your goal, it can be your retirement. So, when it drifts away from its intended goal, then rebalancing is necessary. Normally, this drift happens because of the market movements. For example, you start with 60% equity and 40% debt, and after a strong rally, equity becomes 75%. Now your risk has increased, even if you have done nothing, right? So the key triggers for rebalancing will be, first, it will be allocation drift. You have some assigned weights which have moved significantly. So you have to rebalance it. Then there can be valuation excess. Certain segments of the market can become overheated, and which we can check through the P ratio or the market cap to sales ratio. When these valuations are not justified by the earnings growth of the company, so then we have to rebalance it. Then market always goes in cycles, as we have seen in the previous diagrams that it moves in cycles. Shift in There could be shift in the leadership of a particular industry. So these are the key triggers. Rebalancing has to be initiated. I- If you see from the behavioral perspective, interestingly, this is where the investor struggles the most. Selling what is doing well feels very counterintuitive, and buying underperformers feel very uncomfortable. Even if you know that this is a very quality stock which you are getting at a 50% discounted rate, still you will feel uncomfortable to buy that stocks. Rebalancing requires you to go against your instincts. We approach this through a basic rule-based rebalancing. Periodic review, not daily reactions. Ideally, it can be 1 year. Defined threshold as per the risk appetite of a client or the age of the client or as per the goal, and then clear communication with the clients. Rebalancing forces a discipline in all of us or through all investors. It systematically does what emotions resist. If you don't rebalance, your portfolio silently become more riskier over time.
सो वो फ्रॉम व्हाट आई अंडरस्टैंड कि आपका जो रीबैलेंसिंग का प्रोसेस है, इट शुड नॉट बी रिएक्शनरी। आप उसके लिए एक फ्रेमवर्क सेट कीजिए एंड आप अपने इंटेंडेड एलोकेशन से जितना ड्रिफ्ट हो रहे हैं, यू हैव टू ब्रिंग योर पोर्टफोलियो बैक टू योर इंटेंडेड एलोकेशंस। यू हैव सम गोल्स इन माइंड एंड बेस्ड ऑन दैट देयर इज एन एसेट एलोकेशन। उसको ध्यान में रखते हुए आपको पीरियोडिकली रीबैलेंस करना है। सर, ये तो एक तरीका हो गया रीबैलेंसिंग का, बट आई एम श्योर आपको रीबैलेंसिंग तब भी करना पड़ता होगा एट मे बी डिफरेंट स्टेजेस ऑफ योर लाइफ या मे बी डिफरेंट लाइफ सर्कमस्टेंसेस।
Sure.
इफ समवन इज गोइंग क्लोज टू रिटायरमेंट या किसी का इनकम का कुछ चेंज हुआ है, देर आर सर्टन थिंग्स विच माइट अराइज इन द कोर्स ऑफ लाइफ, तो इसमें भी रीबैलेंसिंग इन्वेस्टर्स को देखनी पड़ती होगी, आई एम श्योर। व्हाट आर योर व्यूज ऑन दैट? आई एम वेरी कीन टू नो।
That's a very important aspect of rebalancing, and it is often underestimated. Rebalancing is not just about the markets; it's about your life evaluation. Because ultimately, you have prepared a portfolio which exists to serve your financial goals and not the markets, right? So the key life factors which we have to take into account while rebalancing is the time horizon changes, because you have invested into some funds or into some, you have made a portfolio for some particular goals. As you progress and as you get closer to the goal, you have to reduce the risk. You have to then, if you want to reduce the risk, you have to reduce the equity component of your portfolio. Then there could be income changes in your life stages. You start from a particular job and then you rise up the ladder, so your income increases. As your income increases, your capacity to take the risk also increases. And there could be uncertainty also, for which you have to need some stability. For example, if you are earning 50,000 rupees per month, so and your expenses may be 25,000 rupees or 30,000 rupees. But when your income increases to 1 lakh, your expenses would still be 30,000 rupees. So you have more income at disposal to invest into the market. And since you have more income, you can allocate a more part of that saving, of that investment, into much riskier asset, which will give you a more better returns on your investments. Then the third part is your goal evaluation. You have to set, because you have some goals, but again you have some new goals. So for that new goal, you have to allocate. There could be allocation requirement for this new goal also. Many investors fails because of this behavioral insight, because they anchor to their old portfolios and their strategies. They don't update their portfolio as their life changes, because a portfolio which was right 10 years back may not be may be completely out of sync today, because markets are dynamic, and because of the changes and technology changes over time. I can give you an example of Kodak. When we were kids, every household used to have a Kodak camera, right? A film camera, and which we used to take to picnics and various our gatherings and social events. Now that camera is obsolete. If somebody has invested amount of money in Kodak stock 30 years back, now that value has become zero. So if you are not rebalancing your portfolio, you'll be losing that amount. So market is very dynamic. At the same time, we normally have a philosophy of continuously aligning your portfolios with the personal goals. For example, your kids' education, marriage, then your retirement planning. Then you have to take into account the cash flow requirement also. Because, for example, after retirement, you will be needing some regular flows of cash to have for your expenses. So that need has to be cared. So at every life stage, there is a different requirement. And also it comes with the risk profile. As you are more aware, so your risk profile changes. Always it doesn't follow your age bracket, but normally it follows some age requirement. Otherwise, an aged person can also take good risk, because he have a much greater know-how of the market. Then aligning of the client's expectation with reality, so that they are mentally prepared for the changes. And rebalancing is not just about the market conditions, and that is very important. It is about staying aligned with your life conditions, and that is what gives you a particular return and which matches your expectations.
That's actually very interesting because generally we look at rebalancing in terms of markets कि markets में ये हो रहा है तो अब हम rebalance कर लें.
What
But
is reaction?
goals को
Always
उसके goals
reaction.
के आप mind में रहे and it's always reactionary like you mentioned. Uh, sir, at a broader understanding we realize कि ठीक है rebalancing is important. Market changes के कारण आपके life circumstances के कारण. But practically, how can one implement this? Because there are situations where we cannot really, मतलब ideally हमें समझ आता है कि ये हमें करना है. But what are the practical steps one can undertake to actually rebalance their portfolios?
You are absolutely right, Mukul. Implementation is the biggest challenge in rebalancing. There are some practical ways through which we can rebalance your color portfolio. One is time-based rebalancing. That is, we have to review the portfolio every 6 months, 12 months, or maybe even in some cases for non-aggressive allocations, it can be 2 years also. The basic thing that you need to check is that you have to avoid over monitoring. Normally, whenever you invest into some asset, we invest into FDs, we invest into some properties. We don't check their prices maybe for 5 years or 10 years down the line. But when we invest in the market, we tend to check every 10 minutes, because information is available, right? For the other asset class, information is not that much easily available, and we also don't bother. But when you invest in the market, but that have very bad implication on your portfolio, right? Then there would be some threshold based balancing. That means your allocation has deviated by 10% or 5%. I have a set mind that I should have an allocation of 10% into large caps, but then it has moved into 20%. So then I have to reduce it. So this is why this is a threshold based rebalancing. Then intelligent or smart use of STTs and SIPs. You have to redirect new investments into underweight assets. The asset class where you have less exposure, you can increase it by doing an SIP or an STP. And it also reduces your need for selling, because then you don't have to sell your good performing stocks for only for the sake of rebalancing, right? Recently, various new funds have come from the fund houses, like the hybrid funds, then the balance advantage funds, and very recently the multiple asset allocation fund. These are for the investors who struggle with discipline, and you don't have to take, the fund managers will take care of allocation of your funds through multiple assets, and they will dynamically manage the risk as well as the allocation part. Here is a diagram of a, take a look at the as a sample aggressive asset allocation strategy, where we can see that for an aggressive investors, could be equity could be 75%, debt could be 5%, and then 10% could be into various precious metals, and real estate or REITs could be 10%. For an aggressive person, this could be it could be one of the sample ideal allocation strategy. But the most important part is a behavioral part. Even with this method, the real challenge is emotional, because market sometimes keeps on moving upward, and you, because since you have reached a maximum threshold on a particular cap or a particular asset, you are not willing to uh, s- sell that or divert that fund to underperforming assets. There is also a question that what if I sell too early and the prices moves up, right? So execution fails not due to the lack of tools. There are ample tools available, but due to the lack of discipline. So we have to have a disciplined approach for rebalancing. For for the clients, we simplify this through a structured process, through some clear rules, and through a continuous communication with the clients. If client understand the process, they don't react emotionally to the outcomes, because rebalancing work the best when it is boring, it is consistent, and it is rule driven. Without the rule, you cannot rebalance it, and you have to follow the discipline to rebalance your portfolio.
That's very interesting. This process should be boring. Rebalancing should not be a very exciting exercise. Otherwise, we'll overdo it and you'll lose the benefits of rebalancing.
Thank
So one final question. We've looked at the process of rebalancing, the advantages of rebalancing. But what's that one mistake that investors can often make? And what's that one thing they should watch out for when it comes to rebalancing?
Yes. If I had to leave investors with one thought, it would be exit, as we have discussed so far, is not about timing the market. Nobody can time the market. It's about maintaining a balance within your portfolio, because market will always go up, market will always correct, and their market will sector performance will always change. This keeps on changing. That's the dynamic nature of market. Since it is dynamic and volatile, that's why it has the ability to generate more return, inflation beating return, because other asset don't give a inflation beating return. But what creates long term wealth is staying invested, staying diversified, and staying disciplined. Though this is the part which is the most boring part, and this boring part generates the returns. And normally we overlook these things, because as you have mentioned earlier, because of so much scrutiny, you try to do the thing, you overdo all these things, right? The behavioral insight is very simple. Normally, what people do is that they enter with optimism and they exit with panic. This is a normal emotional behavior. And emotion and your psychology about money and about your saving and investment plays a very vital role. More than the market and more than the instrument, psychology about money is the most important thing that governs your returns. There is a saying that the biggest risk to your portfolio is not the market, but it's you through your emotional decision making. At SB Wealth, we strongly believe that a good folio fails without the right investor's behavior. And performance comes from allocation, not only from allocation, but consistency comes from discipline. In investing, success is not about predicting the next move, it is about managing transitions. And that transition, by transition, I mean both in market and also in your own behavior and life. The two are juxtaposed. You cannot differentiate the two. People who take risk, they always will be willing to take risk. So in investing, success is not about predicting. We always try to predict the market, but it's about managing the transitions, and whether it is market or in our life, and both aspects are defined by how we behave and how we take the decision based on our emotional uh, solidity.
The final words of wisdom, sir. Thank you so much. I think a lot of our viewers would get a lot of information, useful information, and would actually be a better place to rebalance their portfolios, driven by process, not so much by emotion. Thank you for taking the time out. Thanks a lot.
Thank you, Mukul. Thank you to the whole team for inviting me to do this talk. Nice talking to you. Thanks again.
As Mr. Shiben Bhowmick highlights, investing becomes more thoughtful when it's approached with a clear framework rather than an emotional reaction. The portfolio is shaped not only by where we begin, but how we review, realign, and stay connected to our long-term goals. This conversation reminds us that exit planning is not just about leaving an investment. It's also about understanding portfolio drift, revisiting allocations, and making sure investment decisions are made through a defined framework. All through this, behavior remains central to investment decision making. Over time, investing is guided not just by where we begin, but how we choose to respond to changing market dynamics and individual circumstances. And while rebalancing is important, do consult your financial advisor before making any financial decision. If you like the video and would like to know more about Mr. Shiben Bhowmick, please click the link in the description below. Until next time.
म्यूचुअल फंड निवेश बाजार जोखिम के अधीन है। योजना संबंधी सभी दस्तावेजों को ध्यान से पढ़ें। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स. Read all scheme related documents carefully.